Hello friends, welcome to EduTap. So this lecture is about previous year questions on finance and management is basically asked in RBI grade B and SEBI grade A. So this lecture is useful for you for RBI grade B and SEBI grade A. This is part number 5 of the previous year question series for finance and management, and I hope you would have already seen first 4 parts so that you can continue and watch this part number 5. Anyways, if you haven't seen first 4 parts, you can still continue with this part number 5, since these are individual questions which can be covered without having any past context. So before I start, let me tell you that we have produced excellent results in 2017 and 18. In 2017 there has been 27 selections in RBI grade B and 11 selections in NABARD grade A, and in 2018 the number, that is the final selections in RBI grade B, are literally huge. That's 70 plus selections in RBI grade B in 2018, and in NABARD grade A in 2018 there have been 26 final selections. For SEBI and IBPS FO, still the final results for 2018 are awaited, but we have still produced very good results in terms of 150 plus students have got interview calls for SEBI grade A, which is huge, taking into account that there were only around 230 to 240 interview calls overall all over India. So 150 plus students belong to EduTap and 100 plus interview calls for IBPS AFO. And we hope that we will produce very good results in these exams also, which are bound to be announced very shortly. Now we have individual courses which you can join for RBI grade B, SEBI grade A, NABARD grade A, RBI assistant and IBPS AFO. In case you want to join combo courses, then we have combo courses also for RBI grade B, NABARD and SEBI. And in case you want to join only 2 of these 3 courses, then you can go for other combos like for RBI NABARD, SEBI RBI or NABARD SEBI. So that depends upon individual preferences which one you want to join. And then we have a new course which is QRE course for all banking exams. This is really good course. This consists of quant, reasoning and English. That's why we call it a QRE course. This course consists of ample number of videos, questions for quant, reasoning and English which are being asked in various banking exams and in the phase 1 of RBI, NABARD and SEBI. So in case you are preparing for any of these exams, this is a good bet for you. So this is question number 1 on your screen. The question is that which one of the following is not in definition of annuity? So we all know what annuity is. Annuity is basically a consistent stream of cash flows which are basically equal in value. So suppose you get 500 as rent from your building for next 10 months or 12 months, then that will be an annuity of 500 for next 12 months, because each month you are getting 500 cash inflow, right? There can be annuity for cash outflow also. If you are giving a rent of 500 each month, then that can be an annuity for cash outflow for the next 10 months or 12 months for the amount you are giving that same amount of rent. So the question is, which of the following is a definition of annuity? The first option is NPVs of all the equal cash inflows for a finite period of time minus the NPVs of all equal cash outflows during that period. So it says that annuity is basically net present value of equal cash flows for finite period of time minus the NPV of all equal cash outflows during that period. Is that annuity? No. Next definition is NPV of all equal cash inflows for an infinite period of time minus NPVs of equal cash outflows during that period. First of all, annuity is not for an infinite period of time, it's for a finite period of time. If the time period is infinite, that becomes a perpetuity. Third option is NPVs of all equal cash flows which are equal for finite period. This is right, because I told you NPV is basically annuity is basically net present value of all the equal cash flows which are for a finite period. So that is only for limited period. We cannot say that that is for infinite period. So third is the right definition of annuity. And if you see, this is a kind of annuity. Suppose you are getting 1000 each month for next 5 years starting from this 0th year. Then if we find the present value of this, that will become basically the present value of this annuity, right? So basically now I just want to demonstrate one thing, that some people say that annuity is just consistent stream of cash flows, but some people term it as net present value of these cash flows. So you can say that if I am getting 1000 rupees for next 5 years each year, then this is an annuity. But some people might say that the present value of this consistent stream of cash flows is an annuity. So that does not matter from exam point of view. You can just remember both the concepts, but important is to know what is annuity or what is net present value. Now let's come to question number 2. This is a very interesting question, and I think this question was asked in 17 or 18 exam. And this question is really good. This is a question which is kind of a question which will test your knowledge. The question is, a bank has lent 400 lakh crores. Normal CRR is 20%. New deposits worth rupees 40 lakh crore has come into the bank, and RBI announces that there is a now incremental CRR of 25%. What would be the change lending capacity? So basically, first of all, bank has already lent 400 crore, and that time the CRR was 20%. You all know CRR is cash reserve ratio. If bank has rupees 100 and if CRR is 20%, it means bank has to keep that 20% of that 100 with RBI. So only 80 it can lend. The next part of the question says that now 40 lakh worth of deposits, 40 lakh crore worth of deposits come to the bank, and RBI announces that there is an incremental CRR of 25%. What would be the change lending capacity? Now, what do we mean by incremental CRR to be 25%? When we say incremental CRR is 25%, it means that whatever new deposits are coming after a certain date, on those deposits, the CRR would be 25%. So here the new deposits which have come to the bank are worth rupees 40 lakh crore. It means on these 40 lakh crore, the incremental CRR is 25%, that is CRR is 25%. Now if CRR is 25% on this 40 lakh crore, it means 25% of 40 lakh crore, that is 10 lakh crore, has to be kept by the bank with the RBI. It cannot lend that. So what it can lend? It can lend 40 lakh crore minus 10 lakh crore, which is for CRR, that is it can lend only 30 lakh crore. So what would be the change lending capacity of the bank? The change lending capacity of the bank would be 30 lakh crore increase. So the answer would be option number 1. I hope you would have understood what I have explained. Very simple. The question is that if there is an incremental CRR of 25%, then what is the change lending capacity? First, we have to find the deposits on which incremental CRR would be implemented. Those deposits are worth rupees 40 lakh crore, and if CRR is 25% on them, it means 25% of 40 lakh crore, that is 10 lakh crore, has to be kept with the RBI, and rest 30 lakh crore can be lent to the public. So what would be the change lending capacity? 40 lakh crore minus 10 lakh crore, that is 30 lakh crore. So not a very difficult question, but still you must have knowledge about CRR in detail to attempt these questions, and particularly what is incremental CRR. You should know that. Only then you could attempt such type of questions. So I've already explained you question number 2. No need of further detailing this. Let's go to question number 3. Now again, this question is very simple. This is a numerical worth 2 marks that was asked in RBI grade B exam. The question is, a person has deposited 250 in the bank and he got compound interest at a certain rate of interest. What would be the rate of return if that 250 gets converted into 1000 in 16 years? Now this is not a difficult question again, but you should be knowing some rules to attempt this question. If you are not able to attempt this question without any trick, then it would be very cumbersome to attempt this question. Right. So let me explain you this. The question is very simple, that person has deposited 250 in the bank and it will get converted into 1000 in 16 years, and you have to basically find that what is the rate of interest at which 250 would get converted into 1000 in 16 years. Now if you try to solve this by proper formula for time value of money, you will not be able to solve this easily, and especially when there is shortage of time in the exam. So let me tell you how to solve this. I'll explain how to solve this question and then I tell you the answer also. Your options are 8, 7, 9 or 6%. Basically there is rule of 144 which says that time for making money 4 times in n years, that if you want to make your money 4 times in n years, then the rate of interest that would be required would be 144, because this is a rule of 144 divided by n. And in this question it is given that you are doing it is in 16 years. You are making your money 4 times because from 250 to 1000, it is 4 times. That does not matter. If here it would have been written from 1000 to 4000, 2000 to 8000, all the figures remain the same in the context of this rule, as long as the amount which you are making is 4 times. So here the amount is getting 4 times in 16 years. So the rate of interest that would be required as per rule of 144 would be 144 divided by 16, that is 9%. So your answer in this case would be here option number 3, that is 9%. Again, a very tricky question, could be easily done if you know all the rules, but it can consume all your time if you try to solve this question with a formula. So next question, again a very good question. This cannot be done with any common sense. You need to have good knowledge about Basel norms, only then you can attempt this question. The question is, if risk-weighted assets, that is RWA of the bank, are 560 million, what should be the capital employed by the bank as per Basel and RBI norms? So the question asks about Basel and RBI norms, so you can attempt this question only if you know that capital employed is what percentage of risk-weighted assets as per Basel and RBI norms. These are your options. I'll come to these options later, but let me first explain you how to solve this question. As per Basel norms, your capital employed would be basically 8% of your risk-weighted assets. But as per RBI norms, which further tries to restrict the activity, it says that your capital employed should be 9% of your risk-weighted assets. So as per Basel norms, 8% of 560 million would be 44.80 million, and as per RBI norms, 9% of 560 million would be 50.40 million. Right. So now this question seems very simple. What you would have to do, you just have to find two values. First is 8% of something, then 9% of something, and you are ready with the answer. But behind that is your knowledge. Do you know what are risk-weighted assets, what are capital employed, or at least what the minimum you require to solve this question is, do you know what are Basel norms and RBI norms, and what as per Basel and RBI norms should be the percentage for the capital, what should be the percentage of risk-weighted assets in terms of capital employed, or what should be the capital employed as a percentage of risk-weighted assets as per these norms. So the calculation that we have come out with is 44.80 and 50.40, and in these options, if you see, 44.80 and 50.40 is in option number 2. So this is our answer, and here it's assumed that this is in million because this figure is in million. Now let's come to question number 5. Again, this is a very simple numerical, but again, to solve this question, you should have the basic knowledge of net present value, how to find the net present value, the basic concept of that. Otherwise, it's a simple plus and minus that you need to do to solve this question and get these 2 marks easily. This was a question worth 2 marks. The question is that this is the cash flow of a construction company. The cash flow depicts both the inflows and outflows for the next 5 years, and after that the project will scrap. You have to find whether the project is financially feasible, and if yes, by how much. That what would be your cash flow in terms of if it is feasible, the cash flow has to be positive, and if yes, it is financially feasible, then by how much your cash flow is positive, that you have to find out. And it's given that your initial investment is 1317, right? So here what we are given is present value in all the years: 123, 232, 321, 1422 or 505, right? So point to note here is that 505 is given in brackets. When something is given in brackets, what you need to know is that then it means this is a negative cash inflow or this is a cash outflow, that you are spending this money. This was the only trick in this question. So if I try to solve this question, what I would get is, now you know that to find that whether project is financially feasible, you need to find the net present value, and net present value is basically your you can say sum of all the present values. So these 4 present values in present values of the cash flows for the first 4 years are 123, 232, 321, 1422. And please note, these are not the cash flows in the respective year. This is the present value of the cash flow in the second year. So you need not find present value separately. If here it would have been given that in second year the cash flow would be 232, then you would need to have discounted this to find the present value. But directly here it is given that the present value of the cash flow in second year is this, present value of cash flow in the third year is this, present value of cash flow in the fourth year is this. So you need not find any present value for any of the cash flows. These are already given. So what you need to do is you just need to sum this up. So 123 plus 232 plus 321 plus 1422 minus 505, because this is negative cash flow, and then there is an initial investment also 1317 which needs to be deducted. So the total will come out to be 276. So the net present value is coming out to be positive. It means project is financially feasible, and by how much? It means by 276. So your answer would be basically feasible and by 276. The answer would be option number B, right guys? So again, see, the question is very simple, but you need to know that what are present values, what are cash flows, what are NPVs. In the end, it's a simple plus and minus. Now let's go to question number 6. Now this is again a very conceptual question. Again, this is not easy, and I bet if you could solve at least 3 to 4 questions out of these 6, you are doing very good. I mean, you are a very good material for RBI grade B. Then the question is, what is the assumption in the internal rate of return? That when we calculate the internal rate of return, what is that assumption we make? It assumes that the money which we received in any of these years is not reinvested in subsequent years. Let's try to understand this with an example. Suppose you have made a fixed deposit for 8 years. Each year you are getting a rate of return on FD of 8%. So first year you have made a deposit of rupees 100. First year you get 8%, that is 8. Second year also you get 8. Third year also you get 8. So each year you get 8. But what about the 8 you got in the first year? Do you spend that? Do you keep that under your bed? Do you keep that in your locker, or you reinvest that 8 for next 7 years? Because the money that you have got in the first year as interest, that is rupees 8, will you invest that for the next 7 years which are still left in the maturity of the fixed deposit? Right. So question is like that. So the first option is that you will not reinvest in subsequent years. This is not the assumption in internal rate of return. Let me tell you, internal rate of return assumes that whatever interest you are getting year by year, you are reinvesting that at the same rate of interest for the years which are left till maturity. So in our example, if you would have got 8 as interest in the first year, you would reinvest that at 8% for the remaining 7 years. Similarly, in the year 2, the 8 rupees that you would get in year 2, you would reinvest that at 8% for the remaining 6 years. This is the assumption in internal rate of return. So your first option is wrong. Your second option is, it assumes that money which received in any of the years is reinvested in subsequent years at internal rate of return. This is right. It says that money which you have received in any of the years during the duration of your fixed deposit is reinvested in the subsequent years, that is the years which are remaining till maturity, and the rate of interest at which it is invested is equivalent to your internal rate of return. This is right, and this is your answer. Let me see what is written in option number 3 and 4 to be sure that we are taking the right option. Option number 3 says that it assumes that money which is received in any of the years is reinvested in subsequent years at a discount rate. No, it is assume that it has to be invested at internal rate of return, not at discount rate. So third option is wrong. And your fourth option is it assumes that money which received in any of the years is reinvested in subsequent years at the rate equivalent to cost of capital. This is again wrong, because we are not assuming that money which you would got in any of the years is reinvested at the rate of cost of capital. No, it has to be invested at the same rate which you are getting as your internal rate of return. So your answer is option number 2. Well, that's it guys. Today I intend to do only 6 questions and not 8 or 9 questions, because these were heavy questions, and after watching this video you might be tempted to search a lot on internet. What are NPVs, what is internal rate of return, what are cash flows. All these you might be tempted to search. So search that, increase your knowledge, and in case you have any doubt, please let us know. Right? And in case you have any query about our courses, you can visit our website www.edutap.co.in, or you can email us at hello@edutap.co.in, or you can call us at this number. We are always eager to receive your calls, 8146207241. Thanks for watching guys. Thank you. Bye.